Okay, good morning. So welcome to our second class. So today I want us to look at fund accounting. The expected learning outcome for this class will be 1. Understand the concept of fund accounting. 2. Differentiate between different types of funds. 3. Explain the role of fund accounting in financial reporting. 4. Apply fund accounting principles. 5. Analyze financial statement in fund accounting. 6. Understand the impact of financial accounting on budgeting and decision making. 7. Assess the challenges and the benefits of fund accounting. So those are the expected learning outcome for this particular class. So what is fund accounting? So this is a system used by non-profit organizations, government agencies, and certain business to manage and track financial resources that are designed for a specific purpose. So I think from that introduction, you have actually noted that fund accounting is not used by private businesses. In most cases, it is by government agencies and non-governmental organizations. So the focus of fund accounting is on accountability rather than profitability, ensuring that the funds are used for the intended purposes. So that is to say, unlike in the commercial sector, where accounting is focused on assessing the profitability of the business, for example, getting the net profit, the fund accounting purpose is to see the money, uh, whether the money or the resources has been used for the intended purposes. An example, if the government issues the money for pre-primary education, yeah, the fund accounting has to ensure that indeed the money that was allocated for pre-primary education has been used for that particular purpose. If now we look at, for example, an NGO, if an NGO, for example, let's say Population Service Kenya, give money for malaria prevention, if now the fund accounting is meant to ensure that indeed the money that was given out for malaria prevention has indeed been used for that particular purpose and it has not been diverted. That's why we are using the word accountability and not profitability. So the government uses various types of fund to finance its operation, development projects, and to meet its statutory obligations. This fund can be broadly categorized as follows. So the first one, we have the National Government Fund. So national government funds, these funds are allocated to the central government for its various operations, including administration, public service, and development projects. Some examples of national government fund include, so we have the first one, which is the consolidated fund, and this is the primary account into which all government revenue, taxes, grant, etc. are deposited and from which government expenses are paid for. So the consolidated fund is where the money, as already referred, it is consolidated. So all the money which is being collected for the government, it is deposited in this account. And again, the expenses are also paid from this account. Then we have the development funds. So these are used specifically for financing development projects such as infrastructure, education, and health program. So the money that is used for those infrastructure, including I think the current one, the housing project, yeah, uh, they are being obtained from this fund. Then we have the equalization fund, and these are funds aimed at addressing the disparities in basic services and infrastructure in marginalized areas of the country. For the word equalization means equity. So you want to balance Kiambu County, which is endowed with a lot of resources, with Mandera County, which is endowed with little resources, or Wajir County, or any other county which is marginalized in terms of resource endowment. Then we have the county government funds. And this county government fund was established after the devolution of government functions under the Kenya Constitution of 2010. So the county government were established with their own budgets. County government are funded through one, the county revenue fund. So the main fund into which all revenue, both local and transfer from the national government, they are deposited. These funds are used for county government operations and development projects. Then we have the CDF, and the CDF, this is popularly managed by the area MP. So, and this is a very critical point that we need to understand, that the county government, they normally get a share. I think I don't know whether it is 6 billion per county, but you can research on that. So the money is drawn from the national government and deposited into county government. Then in the same case, we have the money drawn from the national government and deposited to the county development fund. Although these are the county development fund, the CDF was now changed from CDF to NGCDF because of the continuous reasons. The CDF, the county development fund, and the county revenue funds, those two terms were continuous. That is to say, the county development fund is supposed then to be managed by the county government. But now the members of parliament want to manage this kitty, and that is why it is called NGCDF, that is National Government County Development Funds. It was established by the late President Mwai Kibaki. Then we have the donor funds and grants. So these funds come from international organizations, foreign government or non-governmental organization that provide financial aids for specific projects in Kenya. So these funds are often restricted and can only be used for particular project, e.g. infrastructure, health, or education. So now, when the donor are giving money to any specific country, they normally specify the reasons or the particular project which those funds are supposed to be used for. A good example is when some money was given out for tree planting in Kenya. So that money cannot be used for any other specific reason. It should only be used for that particular project. Then we have the concept of the statutory funds. These are funds created by the law or legislation and are meant for a specific purpose, including one, the public debt funds. So the public debt funds, these are the ones which are used to service the debt. I think currently we are at 11 trillion debt. Then we have the judicial fund, and these are meant for running of the judiciary and the court system. All right, so now that is the whole concept of the fund accounting. So now we move on to the financial accounting techniques. So public sector organization may adopt different accounting techniques. The most important are listed below. So we have the first one, the budgetary accounting, the cash accounting, the accrual accounting, the commitment accounting, or what we call encumbrances, and the fund accounting. So let us look at some of them. Budgetary accounting. So this refers to the preparation of operating accounts in the form of budgets. A budget is a management plan that has been transformed into figures necessary to evaluate the achievement of the organization's objectives. Under budgetary accounting, the concept is based on the forecasted cash flows, and operation must be limited to the budget estimate. Organization cannot overspend over the budget restriction without parliamentary approval. So it is in your knowledge, or in our knowledge, that every fiscal year, the Cabinet Secretary for Finance normally presents to the Parliament the estimates. So these estimates are what we are calling the budgets. So the budgets are forecasted of income streams, so that the government is targeting to get income from taxes, from donations, from all the sources of the government, sources of revenue. And then the government must also give the estimated expenditure. So the government say, now this revenue that you have collected, you are going to spend it this way. And this gives either a budget deficit or a budget surplus. In most cases, we normally have the budget deficit, which is financed by external borrowing. So, and then the last statement is where we see that the organization cannot overspend over the budget restriction without parliamentary approval. So this is what we normally call supplementary budgets. So the moment we have the budget, along the year, there are various variation, and this is what we call flexible budget. There are various variations. For example, maybe the target, the amount for capitation was budgeted at a certain amount, but along the year, some variables come into place, and this necessitates for adjustment of the budget. So this budget must be presented to the parliament for parliamentary approval. Now we have the other concept called cash accounting. Under this system, only cash inflow and outflows are recognized and recorded. The system does not recognize any revenue or expenditure that has not been received or paid. Now, remember the popular accounting technique that we call accrual accounting, when we say that revenue is recognized whether the money has been paid or not, and expenditure is also recognized when either, no, I mean, it is vice versa. The revenue is recognized whether the cash has been received or not, and expenditure is recognized whether the money has been paid out or not. But now in the cash accounting, this is where we have the cash inflow is recognized when the money has been received, and the cash outflow is recognized when the money has been paid out to the suppliers. Then we have the accrual accounting. So accrual accounting, again, I have said this is a concept where the revenue is recognized and recorded when the money has been received from customers, and the payment is recognized when the payment is made to the suppliers of goods and services. Then we have the commitment accounting. This accounting system recognizes transactions when the organization is committed to them. It means that the transaction is not recognized when cash is paid or received, nor when the invoice is received or issued, but at another stage when orders are received and placed. This accounting method is meant to ensure that the government unit do not overspend because transaction will only be entered into after checking committed balance. Again, this is an interesting concept that we are going to look at it in a practical form. Commitment, for example, let's say you have committed to pay 10,000 to a particular supplier. So in that, when you commit to pay 10,000, then you record. Yeah. Then we have the concept of, let's say, your customers commit to pay you money for licenses. Let's say we are dealing with a particular government department. So the suppliers has committed to pay a particular amount. I mean, the customers has committed to pay a particular amount. So the government will record this. The government accounting entity will record this. The vice versa, when the government entity commits to spend, let's say 10 million on load or a particular project, then they are going to record this. So this recording is on particular commitment. Maybe when they have issued an LPU, yeah. So you can see this is a deviation from the cash accounting, where transaction is recorded on whether the cash has been paid or received. Accrual, when the invoice has been received or paid. Then commitment, this is on when maybe an LPU has been raised. So those are the three distinctions, and it is important that you understand those three distinctions very clearly. Then we have the concept of the special funds. So some specific departments of a government organization may adopt a special funds accounting according to set objective they have to meet. So the following are some common special funds government organization. One, we have a trust fund. So these are those funds where the government receive money in the capacity of a trustee. They are also referred to as agency fund or fiduciary funds. Example of this fund include NSSF and NHIF. The government organization does not have absolute title to the asset held. There are statutory restrictions upon their use. So trust, it is money held in trust that you have trusted someone to hold money for the public. So we have NSSF. All of us, especially those who are employed, you are aware that every month there's some money that is being deducted from your payslip and taken to NSSF, and this money you are going to benefit from it once you reach the mandatory retirement age, which I think it is 60 years. Or in some cases, this is tier 1 and tier 2, where tier 1 is Tier 1 can be held by NSSF, Tier 2 can be held by any other approved pension funds. Now, then we have the NHIF. Again, these are money deducted from payroll, and this money is used to facilitate the health services. Then we have the sinking funds. These are funds created to account for accumulation of resources for retiring term board at the maturity. Thus, their main purpose is the repayment of public debts. Such funds are set up through the approval by the parliament and some appropriation made from this fund. The amount appropriated are invested to earn interest. When public debt mature, the sinking fund is used to redeem this debt. So sinking fund, in simple terms, it is money meant to pay off debts, the debts which are maturing. For example, you may have a Eurobond which is retiring or maturing in 10 years' time. So the government should have set aside some money to pay off the debt when it matures. Then you have working capital or the revolving fund. So they are also known as internal service funds and enterprise fund. They are used to account for services provided to other departments, that is internal departments, internal service department, external service. So for a fee, usually cost, reimbursement cost, they are set up through approval of parliament to have necessary resources. So in short, the working capital revolving fund, these are funds, they are revolving, they keep on rotating, you know. So some enterprises are given the money. When they exhaust that money, they are given a top up. So the money keeps on revolving. Then we have the capital project funds, and this provides resources for completion of some specific capital projects. The main source of financing such funds include proceeds from treasury boards, grants, and transfer from other ministries and funds. This category exclude any capital project, other transferred or revolving funds. Then we have a special funds or special revenue funds or special funds. And these are the fund of these classes are created and operated to account for revenue designed by the law for a specific purpose. An example of this would be the library service. Then we have the general fund. These are funds established to account for resources devoted to financing the general service which the government units perform for its citizens, and this include general administration, protection of life and property, etc. So let us now look at consolidated fund in detail. So all revenue for the government are recorded into a fund known as consolidated fund. So as I said earlier, consolidated means everything. We are consolidating everything. So the consolidated fund is kept by the Treasury under the Ministry of Finance, and all the revenue and grant received by the government are paid into this account. So everything that is paid, be it from taxes, be it from grant, or from whoever pays the money to this fund. No money can be withdrawn from this account without approval of Parliament. So Parliament is a sole signatory to this account. So the Parliament of Kenya is one which is mandated to give an approval for the money to be withdrawn from this because of public accountability. This is necessary to ensure that all government income are used to carry out activities of public interest, and MP are represented in such decision making through the MP. So this is to say that the reasons why this money has to be approved is because we can't have every Kenyan participating in the approval. We have elected our members of parliament to help us in this. It is also important to note that each governmental unit may be in a position to raise funds from its local activity, e.g. Ministry of Education, from student fee, Ministry of Health from hospital, and this money is what we call appropriation in aid. So the money raised by various government departments, they are called appropriation in aid. So if you go to the hospital, you pay the money for opening the card, you pay the money for school fees for the students and etc. Then each government unit is expected to make a budget of its estimated appropriation in aid and submit the budget to the parliament through the relevant ministries. Appropriation in aid is supposed to be retained by the government unit that generated it, it will be added to the appropriation to cover expenditure of the government unit. So what this means is that, so each department, so for example, let's say judiciary. So judiciary knows that they normally collect this money from fines. Let's say they collect 10 million from fines. So when we are going to look at the budget cycle. So now when the judiciary is submitting its budget to the finance department or to the treasury, they will say that our budget is 20 million. Out of the 20 million, we are expecting to collect 10 million. So the treasury will only give judiciary 10 million because that is the difference between what the judiciary will collect from its own internal generated processes, and then they are only going to be given the balance. So what normally happens is that this appropriation, the judiciary will only be given the balance, and they are allowed to keep the appropriation in aid. So the appropriation in aid is not being asked by the treasury. Now let us look at the books. So the following books of account are kept by each department to record the transactions of the organization. So these are the books which are kept. So we are going to look at each book. So the first one is the cash book. The second one is the vote book. And the other one is the annual account. So these are the books that are normally kept by the government units. So let us look at the cash book. So the cash book is that book in which all receipts and payments are recorded. So as I already refer cash book, we record the receipts, and then the other side we record the payment. And I'm very sure this concept of the cash book from your financial accounting class, all of you are familiar with it. So types of cash book, we have the receipt cash book. So the receipt cash book track all the cash received by the government, including tax revenue, grants and loan. Then we have payment cash book, and this record all the payments made by the government, such as salaries, procurement, and payment of services. Now, so this is an example of a cash book. Yeah. So the following cash transaction took place for the government unit for the month. So if you look at this, these are the dates, the transactions, and the amount. So these transactions, you realize that some of them are receipts and some of them are cash. So let us look at the first one. On 2nd of January 1998, the opening balance. So we have the cash. This is the cash it had. Opening balance was 4,000, and bank was 25,000. Then we have on the same date, there was some money that was received, that amount there. Then on that, there is some amount that was paid, 20,000. On 5th, there is some cash that was received, 25,000. On 5th, there is some money that was paid, 8,700. On 6th, some money was paid, 52,000. On 6th, some money was paid, 2,800. On 8th, some cash was received, 210. On 9th, some wages were paid, 5,000. On 10, kept cash balance of 10,000 and banked less together with a check in hand. So the money was taken from cash and was taken from the bank, and only 10,000 was left from the cash. So let us prepare the cash book. So now the first thing to do when you're preparing the cash book, have two sides. So there is the cash for, there is a debit side for money in, and there is a credit side for money out. So the side for the money in has a side for the cash and has a side for the bank. So all these are money in. Then we have this other side for money out. So we have the side for the cash and we have the side for the bank. Okay, let us now enter this transaction. So the first transaction here, we have seen it is the opening balance. So we had an opening balance of 4,000 in cash and 25,000 in bank. And you have realized that these are positive amounts. So you debit them. So you come here and enter the first two transactions. 2nd January, these are balance brought down. We have 4,000 in cash and 25,000 in bank. Let us look at the second transaction. Received cash in respect of trading, 62,500. So there's some money that was received. This is the money, 62,500. Unless it is specifically indicated bank or cash, you can assume maybe the default is cash. And then paid Peter and Son 20,000. So the money was paid by check, 20,000. You can see that one is very clearly indicated. That is the bank that Peter and Son were paid 20,000. Then we have cash received in respect of fee 2,500. You go there, fee 2,500, and then some money was paid by check 52,000. You come here, you record 52,000. The money that was paid by check, and then cash paid cash to James 2,800 was paid. You come and record 2,800 paid by cash. And then received the cash for licenses 210. You record the 210 that was received there. Then paid wages in cash 5,000. You record the 5,000 here. Yeah. Then kept a cash balance of 10,000 and banked the rest together without check. So this is the last transaction. So in cash, we are going to have this. We are going to have the balance carried down of 10,000. So what you do here, you should come and balance here. This is cash. This is cash. So that's just balance cash. And we know very well that we are only supposed to be left with a balance of 10,000. So you add this. Once you add this, you get this amount. But remember, once you get this 279, remember what you have said that we are only going to be left with 10. We are only going to be left with 10,000 in the bank, in the cash. So you balance this one here. This is 279. Then you balance here. So what you're going to do is that the moment you balance, you see this is 279. 279. This is 279 here. Yeah. So this 279, get the totals of this one. So for example, the totals of this one without these two first. Yeah, without those two first, you're going to get what? Let's see. Let me just get that. So without that, you're going to get 2,800 plus 5,000. So you're going to get 3,300. So then 3,300, the combination of, no, sorry. You're going to get 7,800. That is 2,800 plus this. You get 7,800. So then that 700, that one, add that we have been told that we are only going to be left in 10,000 in cash. Add this, bring this one here, the cash carried down 10,000, add 10,000 to that one. So you're going to get 17,800. 17,800, if you raise from this one here, the 279, yeah, the 279 minus this one minus 279. Yes, 279. If you raise this one, you are going to get 261,200. This 261,200 is the money that is going to be removed from cash taken to bank. So because the money is being removed from cash, so here you are going to credit cash here. Credit cash and debit bank. So that's the balance of. So you can now see we have balanced the cash here and we have balanced the cash here. So bank, again, you do the same. Get this total here, get the total here. Yeah. Once you get the total there, then you're going to get the balancing figure, the balance carried down, which is 252,300, 252,200 on this side. That is the balance brought down. Remember, both of them, they have a debit balance. So this balance brought down is one which is going to become the opening balances in the next period. So that is how we prepare the cash book. So then I would want us to try this activity too in form of an assignment, and then you can share your working by Friday this week. Thank you. all of you. In the event that you have any query or clarification, please reach out and I'll be able to assist all of us. Thank you. Have a good day.